Picture this. Dave from Houston, 48 years old, works in project management, started building a weekly dividend portfolio in late 2024. He found a fund called MSII. It tracked MicroStrategy. It paid weekly dividends, and for a while, it was working beautifully. Dave watched his total returns climb 10%, 20%. At one point, total returns were reportedly as high as 44%. He showed his wife the numbers over dinner. He told his buddy about it on a fishing trip. He felt like the smartest investor in the room. Then one morning, his brokerage sent a notification. The fund was being liquidated, not because it lost money, not because it performed badly, it was shutting down, even after that incredible run. How is that possible? By the end of this video, you'll know the one number that tells you, before you buy, whether a weekly dividend ETF is built to last or built to disappear. And the part that surprised me most, this number has nothing to do with returns, yield, or performance. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. So what's the number Dave missed? It's something most investors scroll right past, and it would have told him everything. The one number most investors scroll past. The number is AUM. That stands for Assets Under Management. In simple terms, it's how much total money investors have put into a fund, not how much the fund earned, how much money is sitting inside it right now. Here's why that matters more than you think. ETF issuers are businesses. They make money by charging an expense ratio, a small percentage of the fund's total assets as their annual fee. That fee is how they pay their team, run their options desk, and keep the fund alive. Now, here's where the math gets real. When a fund holds $100 million in assets and charges about 1%, the issuer collects roughly $1 million a year. That covers everything and leaves room for profit. But when a fund holds just $1.5 million, that same 1% generates about $15,000 a year. $15,000 for the entire year. Think about that. The fund was paying investors weekly dividends, and the company running it was going broke doing it. So what's the magic number? According to Morningstar, the break-even point for an ETF is roughly $33 million in assets. ETF.com puts the viability line higher, around 50 million, and most industry experts say a fund needs 100 million to be truly stable long-term. Now let that sink in for a second. The funds that got liquidated, none of them had even 5 million. They weren't just below the line, they were in a completely different universe. And that leads to the biggest myth in weekly dividend investing. Here's the myth. If a fund performs well, it's safe to hold. Here's the truth. Performance keeps investors happy. AUM keeps the fund alive. Those are two completely different things. Smart investors track both. Most people only track one. So just how small were these funds that got cut? When I pulled the actual numbers, the gap between the ones that survived and the ones that died was jaw-dropping. 7 died, 3 survived. The dividing line. On June 16, 2026, Rex shares liquidated 7 weekly dividend ETFs all at once. The funds that got cut were COI, CWI, HOI, LLI, PLTI, MSII, GIF, and AYI. Here's what their assets looked like, and these numbers tell the whole story. HOI, the Robinhood Fund, had about $810,000. CWI, CoreWeave, had roughly $900,000. GIF, the Universe Fund, sat around $1 million. PLTI, Palantir, held $1.74 million. COI, Coinbase, had $2.1 million. MSII, the MicroStrategy Fund with those reportedly 44% returns, had about $3 to $4 million. And LLII, Eli Lilly, had roughly $2.5 to $4 million. Every single one was under $5 million, not even close to that $33 million break-even.
Now look at the survivors. NVDI, the NVIDIA fund, held approximately $102 million in assets. That's more than all 7 liquidated funds combined, times 10. TSLI and WMTI survived too. WMTI only held about 7.5 million, but NVDI carried the whole suite. It was the anchor that kept the others afloat. And here's something a lot of people got wrong online. Some channels reported that FEPI, SEPI, and AIPI were part of the situation, but here's the thing. There is no SEPI. It doesn't exist. The correct funds are FEPI, AIPI, and CEPI, and they were not liquidated. They were converted from monthly to weekly payouts on May 28, 2026. That's great news. FEPI alone holds $686 million in assets. That's AUM doing its job. Performance didn't decide which funds lived. Money in the fund did. And that right there is why AUM is king. So now you know what killed these funds and what saved the others. But here's the question I hear most, and honestly, the answer is the best news in this whole video. What happens to your money if a fund you own gets liquidated? Most people assume the worst. The reality is very different. But quick, before I show you, drop a comment right now. Have you ever checked the AUM on an ETF before buying it? Yes or no? I read every single comment, and I think the answers are going to be really interesting.
What actually happens to your money? Here's the good news. ETF liquidation is not bankruptcy. I know that word liquidation sounds scary. It sounds like your money disappears, but that's not what happens. When an ETF gets liquidated, the SEC requires an orderly wind down. The fund sells all of its holdings. Then your brokerage pays you cash at the fund's net asset value, usually within 3 to 5 days after the final trading date. Your shares don't go to zero. You get your money back. Now, this is completely different from a stock. If a company goes bankrupt, your shares can become worthless. If a stock gets delisted, you might be stuck on an illiquid market with no buyers and no way out. But an ETF holds a portfolio of real assets, actual stocks, actual options contracts. Those assets belong to the fund, not the issuer. So even if the company running the ETF has problems, your investment is backed by real holdings. That's a crucial difference. One quick tax note. In a taxable account, the payout counts as a sale. You may owe capital gains, or you might be able to lock in a loss. In an IRA or a Roth IRA, there's generally no immediate tax hit. So the money is safe. That's the good news. But the income stream isn't. And for weekly dividend investors, losing a reliable payer is the real cost, even when you get every dollar back. You have to find a new fund, you have to reinvest, you have to rebuild that income stream from scratch, and that takes time. That's why the smartest move isn't reacting after a liquidation happens. It's never owning a fund that's sitting on the chopping block in the first place. And there's a simple way to check. Takes about 30 seconds.
This is the part of the video where everything comes together. 4 simple steps, 30 seconds each, and they can protect you from every problem we just talked about. Step 1. Before you buy any weekly dividend ETF, check its AUM. You can find it on ETF.com, Morningstar, your brokerage platform, or the issuer's own website. It updates every single trading day. There's no excuse not to look. Step 2. Apply the threshold. If the fund holds less than $50 million in assets, and that number has been shrinking, that's a caution sign. If it holds over $100 million from a strong issuer, you're on solid ground. Step 3. Check the issuer behind the fund. This is the part most people skip, and it matters. A smaller fund from a large issuer has a safety net underneath it. YieldMax runs 59 funds with roughly $10 billion in total assets. Their flagships, like MSII, generate enough fees to cross-subsidize the smaller funds. Roundhill's weekly pay suite crossed $1 billion. Those big anchors help keep smaller funds alive. But a small fund from a small issuer, there's nobody to absorb the losses. That's exactly what happened with the Rex Growth and Income Suite. Without a massive anchor, the smaller funds couldn't survive on their own. Step 4. Watch the trend over time. AUM that's flat or slowly growing means the fund is healthy. Investors are staying in, money is flowing. But AUM that's been declining for 3 months or more, that's your warning sign. That's the signal to pay close attention. Now, remember Dave from Houston? He didn't know any of this before. He bought MSII because the returns looked good and the weekly dividends felt real. He never checked the one number that mattered most. But now he does. His new weekly payers sit well above the line, funds with 100 million or more in assets, strong issuers behind them, weekly dividends built on a foundation that can actually hold. Same income strategy, same weekly paycheck from his portfolio, completely different foundation underneath it. And that's not a recommendation. Those are examples of what AUM looks like when a fund is truly built to last. Smart dividend investors don't just chase yield, they check the foundation underneath it. That's the difference between hoping your income lasts and knowing it will. And if you remember one thing from this video, make it this. Returns tell you how a fund performed. AUM tells you if it'll survive. Write that down, screenshot it, tell your spouse about it tonight, because that one sentence is worth more than any yield number on a screen. If you know someone building a weekly dividend portfolio, send them this video right now. This one number could save them a real headache, and they'll thank you for it. Now I want to hear from you. What's the smallest AUM you'd be comfortable holding in a weekly dividend ETF? Drop your number in the comments. I'm curious where everyone draws their line. If you're building income from your investments and want to stay ahead of changes like this, subscribe to this channel. I cover everything that protects your income and helps it grow. And in my next video, I'm ranking the weekly dividend ETFs that are actually built to last by the numbers that matter most. You won't want to miss that one.